And hi everyone, nice meeting you. I'm gonna stay here, right? Yeah, and thanks for the panelists for being here and sharing your thought with us. Just as a quick introduction to the panel here in front of you, there are investors and people exposed every day to innovation, and you can count among us, I think, over 50, 60, probably 70 years of venture capital investment experience and an exposure to over 100 companies, probably more altogether. So a hell of a lot of experience and lots of going through lots of round of financing as well as exit. And thank you to LSI and the organization for inviting us on that topic, which in a time frame like this one couldn't be more challenging than discussing exits and alternative exit, especially. I mean, trying to solve the big question we have today in the industry, which is how we go over a time where liquidity is certainly scarce and exit opportunities aren't many. So we're going to start with a quick round of introduction. I'm going to start from the bottom there, Enric. If you want to just 1 minute about yourself and about EIC, that would be great.
I'm Enric Claverol. I'm responsible for the medical technologies portfolio at the EIC. As you might know, the EIC is the new vehicle, relatively new vehicle created by the European Commission, so it's fully public. It was set up in 2021, and the goal is to support startups across multiple areas, not just medtech. Medtech is about 30% of our portfolio. It's a relatively large vehicle. We invest 1.1 billion a year. And of course, exits will be critical for us. So our focus is now moving from the operational aspect of running all the evaluation of opportunities to finding paths for exit. So it's a very important subject for us.
Thank you, Enric. Clara.
So Clara Campas, co-founder and managing partner at Asabys. We are a venture capital firm here in Barcelona, now fundraising and launching, already investing from our second fund. We invest across the board in health innovation, so from biotech, biopharma to medtech and digital. So happy to be here. Thank you, Diana.
Thank you, Clara. Alex?
Alex Schmitz, I'm a partner at Endeavour Vision. We're a transatlantic healthcare investor focused primarily on medical device and digital health companies. We have about $1 billion under management, currently investing out of EMG2, expect to be investing out of EMG3 shortly. And we're focused mostly on growth stage companies, so generally post-approval, early commercialization up to large-scale pre-IPO growth equity rounds.
Okay, thank you, Alex. And about myself, co-founded Panakes. With Panakes, we invest out of 2 funds. The second one recently raised 180 million. We invest any stage, primarily across Europe, and primarily in medical device, but also in biotech, digital health, and diagnostic. So thank you guys for being here. Exciting. Till yesterday, probably, we had a little bit of a different view. What are we going to talk about? If the IPO market is completely closed, we hadn't had any medtech early stage companies going public for a long time. M&A is closed. Is it closed, Alex, completely? Or maybe you have something you want to talk about, a big announcement yesterday.
Yeah, so obviously many of you may have seen yesterday's announcement that Boston Scientific has entered into a definitive agreement to acquire one of our portfolio companies, Relievant Med Systems, for $850 million upfront with some significant commercial revenue-based milestones over the next 3 years. So we're obviously very excited for the company, the team, for the investors, and for Boston Scientific, which we think is going to do an amazing job helping to bring this important therapy to the many millions of patients that suffer from vertebrogenic lower back pain. For the broader medtech ecosystem, it's obviously great to see significant M&A activity. We have seen, even though I know, and we'll talk more about it, it's been a challenging period, certainly from an IPO perspective, where we've had essentially a 2-year drought following a wave of IPOs in 2021. M&A volume, both in terms of dollars and deals, has actually been slightly ahead of 2022, although down significantly from previous years. The encouraging news, I guess, is that of the top 9 large cap medtech companies, they have about $117 billion of firepower available for M&A transactions based on their current balance sheet and leverage ratios. And so there's ample capability to engage in M&A, and we'll talk, I think, a little bit more about what they may be looking for and how those of you that are investing in or running device startups can best position yourselves to attract some of those dollars. But the M&A money is there, and the strategics are looking to deploy it, and I think it's our challenge to create opportunities that are enticing and attractive to get them to do that.
Well, fantastic. Can you elaborate just a bit on the stage of the company was in? Because that's a probably great input for the audience here.
Yeah, happy to. And maybe just step back. I mean, generally, when you look at medtech M&A over the last 4 or 5 years, and I'd probably say, even longer than that, but the data that I've seen recently from Guggenheim went back to 2019. There's sort of 2 types of M&A transactions. There's pre-approval. Those tend to be data-driven. They tend to cluster in cardiology, electrophysiology, structural heart, data-driven specialties where a positive readout on a pivotal study in the US can be a catalyst for M&A. That's probably about 10-15% of M&A. The vast majority of medtech M&A occurs at the commercial stage, at or above 10 million in revenue. And so I think when looking at M&A opportunities and how to drive toward them, you need a clear commercial strategy to get to some level of scaled revenue, where you've demonstrated that you've got a product that has market fit, a commercial model that is working, and that in the hands of a larger acquirer could be something that can scale up. I think in the current high interest rate environment, the pressure on strategics vis-a-vis earnings per share and cost of capital probably raises the bar, and so you should be thinking about ways to get to not just the minimum, which is probably 10 million, but beyond that to 20, 30 million. In the case of Relievant, the company was on a pretty nice trajectory from sort of low single-digit million, doubling more or less every year, and this year is expecting to finish north of 70 off of a $38 million number last year, with Boston publicly guiding toward 50% growth next year, which would obviously take them up into the kind of $120, $130 million range. So I think there is definitely a premium for scaled assets that can plug into a commercial infrastructure and actually move the needle at the group level, or at the other end of the spectrum, strategic assets that fill an important hole in the portfolio of large franchises like EP, structural heart, et cetera.
Great, thanks for sharing. And I mean, we should really celebrate the exit, because I mean that's probably it demonstrates the sector is still alive, and I mean there's a lot of interest, even though in this time frame we don't see a lot of those transactions. But great, let's hope it's a first
hope
of
there's more to
a
come,
number.
there's been a few, Saraceni in the neurovascular space earlier this year, and Palette in the urology space that Teleflex acquired for 600 plus 50 in commercial earnouts. I mean, those are substantial transactions. So there's reason for hope and optimism, although there's a high bar, I think, in terms of scaling the business and having something that can be plugged into an existing sales force.
Right. Thank you so much. And then when you think of alternatives, I mean, we probably all of us have in mind that there could be this industry could somehow consolidate. It's probably a nice way of producing a larger player and making them more attractive, even for buyer or eventually for the IPO when it's going to come back at some point, reopen the IPO window. Do you guys see? I mean, Enric, you have exposure to many companies through the various. It's a certain number we heard, and do you see a lot of how do you see a lot of this happening? A lot of companies talking to organize consolidation, or investors that are behind the scenes doing it?
The AAC is a very special vehicle in many ways. First, the size is crazy. Sometimes it's difficult to manage. And the other thing is that we go in really early stage, which doesn't help in seeing the path to exit sometimes. But we do realize that it's really important to see that path. First, we have problems. Sometimes we are locked up with this co-investment situation, because we come in, we commit 6-7 million, and then the companies cannot find co-investors. And partly it's because there is no liquidity in the market, and we perceive that as a major issue. So we try to come in, we want to create this cascade effect, this domino effect, and we don't see it because there's no liquidity, so nobody wants to join us. So we try to see paths to visualize the exit. And we're trying to think, the legislator is close to us. We're not really legislating ourselves, but they are close. So we're trying to be creative about this. And some ideas that I'm happy to share and see what you think about this. So for example, the new crowdfunding legal framework, for example, allows for a secondary market in crowdfunding. So it's amazing when you look at markets like NFT or crypto, for example. There was so much liquidity, and the asset itself was not really that solid. And still, we see our companies, or lots of scientists coming into our pipeline, really building stepwise value into their companies. There is no liquidity. Come on, this is not fair. I mean, there's something crazy about the market. So one of the things we try to do is be creative. Come on, if we are adding value to those companies, they are adding value. I mean, we don't, but we're with them. We have to find ways to create liquidity. And maybe a secondary market early on could help. And so this is one of the things I wanted to throw into the discussion. Would this make sense to create a secondary market before an IPO or an M&A is possible? It's just one of the thoughts. We have many thoughts running our heads, but just one idea.
Well, any interested investor, you talk to Enric. And Clara, I think we should really leverage your experience also on the biotech side, which could be inspirational for medtech and the sector, because I mean, it's in biotech, there are a number of M&A opportunities that come much earlier than in medtech. And how is this applicable to medtech or to some segment, if at all? I mean, or what kind of alternatives are there for to raise money that in biotech that could find a spot in medtech as well?
I think that in biotech, you sometimes have in mind what we call the risk of refinancing. I mean, you have that in mind all the time. I think in medtech it's obvious, right? So I think in medtech, going back to the two scenarios Alexander was making, so you can sell the company or exit before getting into market or after. But I think that you always need to have in mind in medtech that you might need to go to the market, to go through all the regulatory process, to build somehow your commercial strategy, not your commercial team need it, but you need to know how to reach the different markets in a good way. It's not just have regulatory approval, now just I'm here waiting for someone to jump in, which has been a little bit the trend for some strategies. So I think that always, even from the very beginning, you need to have this in mind from the manufacturing perspective, from the commercial perspective, from every perspective, and from the funding and financial perspective. I think that's very different from what we see in biotech, particularly at this stage. Sometimes when you invest in biotech, I don't know, at the very end of phase 2 or starting phase 3, you might face that risk. It's something you might consider on the table. But I think that for medtech is a must. You need to be ready to face those steps on your own. And it will have to do also with the secondary. I mean, probably not the secondary as Enric was referring to, but one of the, on top of IPO, M&A, or consolidation, with probably we will touch base. A question mark is whether the private equity will at a certain point jump in companies as mature as the one Alexander was referring to, with consolidated revenues, growing revenues, as an alternative, perhaps to the IPO, right? Partial or complete secondary or sales to private equity, which are more and more ready to understand the business, I believe, and less generalistic in their ways. So perhaps that's something we can also explore.
Yeah, I mean, crossover funds, for example, which exist a lot and are very active in biotech. I haven't seen almost being active in medtech. Why not? There should be a similar. Be similar.
But I think that goes back to the sort of dearth of IPOs in the last couple of years. In the 2020-21 period, there was a lot more activity from crossovers into later stage medtech deals that were anticipating going public. You know, the cohort of medtech companies that went public in 2021 has not performed well, partly because of just the overall market environment and in rising interest rates that put pressure on the stock prices, partly because some of them didn't perform well in their early period as public companies. But I think that's put pressure on the crossovers. But we've continued to see activity. I mean, Alibridge, which is
it's
late growth crossover fund, invested in Relievant earlier this year because we were expecting to build the company out and potentially take it public next year when the proverbial window reopened. Obviously, things took a different path, but there's activity, but I think less than what you typically see on the biotech side, although I think that goes hand in hand with the relatively lower volume of medtech IPOs versus biotech IPOs, because ultimately the crossover funds are playing that arbitrage into the IPO, whereas the vast majority of medtech companies, if they exit via trade sale.
Okay, well, let's pick up another one, another topic. There were a couple of companies just recently in the last 2 months going public through the SPAC model. And they were both in medtech, and namely Sonowave and Allurion into their revenues, in the revenue stage. And raising, it's a nice way of raise money and go public at the same time with this transaction. Do you do that? Do you consider SPAC model? Or
not yet at the AC. We're very conventional. We're just starting, and this sounds a bit far-fetched for us in our approach.
Yeah.
So we try to get the companies to generate revenue as soon as possible, get the CE marking as soon as possible. It's not easy with MDR right now, and build a solid, credible business. Maybe the SPAC model is a bit, for us, it's a bit too far.
But Enric, if a company, I mean, in the future, IPO window allowing, would come to you and say, we're matching the ESC money with the IPO, is that feasible or?
With an IPO?
Yeah.
We will be the first time that happens, but we could look into
would that
it.
feasible? Yeah, okay, just speculating, sorry. But going back to the SPAC, did you consider any of that, Alex, for Livian or other companies mature?
So we watch the SPAC phenomenon closely, both as a way to potentially fundraise for our portfolio companies and at one point in time as a potential vehicle to raise money to invest out of, as a sponsor when SPACs were sort of on the rise. And SPACs as a vehicle have been around for decades. They kind of had a resurgence in the last cycle. But my personal view is that there's a limited number of circumstances where public offering via SPAC makes a lot of sense versus a traditional way IPO. One scenario where it could make sense is if you've got two private companies that you think could merge.
And then you do through
a SPAC can be a way to arbitrate the valuation disconnect, because getting a bunch of VCs together to decide on the relative values of two of their portfolio companies is an impossible task because everybody thinks they've got the prettiest baby. But if you've got a neutral third party that's providing the capital, that can set a valuation. We didn't see that in the last cycle, but that's an application for a SPAC. I think, for the most part, a lot of companies that went public via SPAC did so because they weren't, they concluded that a traditional way IPO wouldn't work. I think some of them, people got excited by the sponsor promote and the economics there, which if you pulled it off successfully could be pretty attractive for the sponsor. I think that's pretty much pulled back, and certainly in our portfolio, we're not really considering SPAC as a path to a public offering. Our view is if you're going to go public, to really exit and monetize your investment as a venture sponsor, you have to attract high-quality institutional long-only funds that are going to be shareholders in the public company and create liquidity and trading volume to allow you to sell down your position. If you don't have that and you're public, then you're public, but you're stuck. And some companies that went out in 2021 that have traded down 70, 80, 90% or more off of their IPO price are sort of in the doldrums. They're public, but they don't have an institutional shareholder base that creates liquidity, and so investors are stuck. And I think for us, the goal of an IPO is to raise enough capital to accelerate growth, and also to provide liquidity for the private venture investors that got the company to that stage. And SPACs don't seem to me to be the best way to do that, but every company is different, and I'm sure there will be successful examples of people going out via SPAC IPO.
Clara, any different opinion on that?
No,
or-
Dio, I mean, I fully agree. I think that on one side, it's good to see that the SPACs are finally happening up to the end, let's say, not only raising, but also executing the mandate. I do agree it's a nice way to help or to vehicleize that consolidation we were speaking about, to make more robust companies to then be able to face the public market and the way of moving forward. And if they are professionalized enough, I think that would be a good thing. So everything that creates optionality is good. But of course, when making a decision or when a company needs to make a decision on whether this is a solution for them or not, you need to consider the impact and the value it might have compared to the time you gain in going public. So I think it's about the momentum case by case.
Thank you.
Just on the SPAC, so I don't think the EAC will ever be close to the idea of a SPAC, but building credibility is something that really worries us. And maybe the mechanism has been a bit too aggressive in a way. So, but if it works, but it has to be something that builds credibility for us because the EAC is just new. But we're not close to a SPAC at all.
Mm-hmm. Okay. Well, then let's take it. I mean, we are in a difficult time for exit, so a company can scale up and use this time to scale up and become more mature and potentially prepare for an exit later on, assuming that's the best way and the best recommendation for the time being. They have to raise capital to do that. And the panel, the title of the panel is also about alternative way to scale up. So assuming that, given that the number of investment the investment pace has slowed down as well, there are less number of deals. They're maybe bigger in size in medtech in particular, but less of them. And there are some players that completely disappeared, like we had in the past some Chinese investor medtech companies or funds investing in equity and taking position on joint ventures eventually that are not really active anymore, at least for the equity part. And the strategics, there's a number of them that are slowing down the pace as well into investing in early stage companies. They're going towards more mature company, taking care of more into and taking care more of profitabilities of the company, of their own companies, rather than making new investment in new technology, some of them. So what's the recommendation? What's the alternative way of scaling up when the usual players are sort of withdrawing a bit from the market? What's the recommendation?
One additional thought, maybe a bit unusual again. So when we try to create paths for our companies, we talked to Euronext and talked to Nasdaq Nordic. And for Sweden, for example, it's really, really interesting how the government has created this, some years ago, these investment accounts where they have this particular tax break. It makes everything very easy for the retail investors to come into this type of companies. So I think that's another possibility to create new ideas because the IAC was thinking about new ways of doing things. Maybe at the European level, we can create some kind of mechanism that facilitates for retail investors to go into these companies really early on. And then, of course, the IPO path should be open, but then we should facilitate from the legal end and the tax framework that retail investors can go. And I think any ideas we can create to generate more movement early on, because we do see a lot this situation where our companies are really early stage. Some of them are not even first in human yet. And we see even strategics say, look, it's too early. We have a long list of companies at that early stage to have to find ways to help them.
Okay.
I mean, that said, I mean, there are many strategic, investors represented here at LSI, from both the formal venture arms or from the business units or corporate development units. And I mean, I think they remain very active investing in early stage companies. They don't always disclose that they're investing. So sometimes I think you get the impression that they're sitting on the sidelines, but I think that the strategics have remained active. And if anything, they've filled part of the gap, at least, created by an absence of traditional venture funding going into early and mid-stage companies. That I was talking with somebody earlier who raised a seed round from two unnamed strategic investors, and I think, but I think there, back to the sort of bifurcation between early data-driven exits and later commercial-driven exits, you're unlikely to attract strategic investment at the sort of seed or A stage if you're in a category that isn't likely to drive a data-driven exit. So there is a little bit of a bifurcation, and if you're in that sort of second category, which is probably 80% of medtech, my advice would be, and I've seen this more, and it's evolved over the last couple of years, but working backwards from the end state. Okay, if I need to have a certain level of revenue to get acquired, what do I need in order to get there? And so, yeah, you need a product, and you need presumably clinical data, you need a regulatory clearance, but you need, I think, a path to the US and a clear strategy around getting reimbursement, coding, coverage, and payment. And starting there sometimes, and then working backwards from what are you going to need to do over the lifetime of the company to get to the point where you've got those sort of the famous 3 pillars of reimbursement, without which you're probably not going to get to 50 million in revenue and drive an outsized exit, right? So you want to be thinking about that early on, embedding health economic outcome data into your pivotal study where possible, not always possible, working with FDA and CMS on sort of dual track evaluations to try to accelerate the time between regulatory approval, clearance, authorization, whatever your pathway is, and coverage from CMS and coverage from commercial payers. But that's really important. I mean, one of our other portfolio companies in the women's health space is only expecting their Category 1 code to kick in January of next year, but they've already lined up 270 million covered lives in the US and I think 19 of the top 20 commercial payers, because they had such strong health economic data that even without a Category 1 code, insurance companies were lining up to pay for the procedure. We hope that Category 1 will sort of unlock that, but if you get to the end of it and you got Category 1, but you don't have good HEOR or HECON data, you're still going to have a struggle with the payers, and that's going to be the rate limiter on how fast you can scale revenue, and therefore how quickly you get acquired. So I think in the past, we used to think about these things in serial, and unfortunately now I think you have to do them at least partially in parallel so that you compress the time and therefore the cash you need to get to scaled revenue that's going to drive an exit.
Well, a paradox that we have this market of 400 million population, and most of our companies come to us saying, no, I want to go to the US first because that gives credibility to my exit. It's amazing. We have to change that. We have a huge market. Okay, it's fraction, it's a puzzle, but we need to solve that. We support these companies with public money, taxpayers' money, and they want to go to the US to guarantee their exit. We need to solve that.
Reimbursement and all of that, and especially with the new MDR, I mean, that has a major impact.
And I think that's where the disconnect for me is. On the one hand, you've got the commission saying we want to invest a lot of money in fostering innovation and creating an ecosystem. And on the other hand, you have different parts of the European government saying we want to make it much harder to bring products to market.
Absolutely.
And then you've got the national level reimbursement, and it's been a challenge. I mean, I think MDR, as you point out, has made it
before the new MDR, it was more balanced. There were companies that
I totally agree.
picked up the US for marketing reasons, and
so hopefully
now
your
it's everyone.
can talk
I'm
to
trying.
the other folks.
I'm not succeeding yet. But
they got to sit down together and sort this out.
But this is really interesting, where the legislator originally had a very good idea. We want to make medical devices regulation safer, because of the breast implant issues. It's totally clear. And then it's propagated down to the execution body, and it becomes confusing, too legal. And how do we solve that? We are working on it, but we're not there yet. I certainly tried, but I haven't managed so far.
Yeah, but it was strange. I mean, before MDR, you were speaking with European companies saying, well, we will go to Europe first because we are here, we understand
Not
it.
anymore, no.
But our huge market is in the US. and they say, okay, why don't you start with, globally at least, no? Now it changed, so it's like we went the other way around. And I fully agree with Alexandra. I think that consolidation is something should be happening also at different levels, not only
yes.
at...
I wish it was in my hand.
Yeah, I know.
and the other thing that we were discussing with some companies here yesterday is per-commercial procurement. So this is funny, maybe some of these companies were here. So we have public hospitals using taxpayers' money to choose technology, and they go everywhere, but in our own portfolio. All these things, we need to solve those paradoxes.
Yeah.
Maybe on a positive note, though, I mean, a decade ago, it was the exact opposite. And there was a concerted effort between the government, FDA, CMS, Congress, and the medtech industry, AdvaMed, Josh Macauer, who gave the keynote talk last night or fireside chat, authored or co-authored a paper about the need to make the US more competitive. And that led to, over time, a series of changes that have made the US more competitive. And then at the same time, MDR came out and swung the pendulum the other way. But I think it's possible. It's more complicated because it's just a more complex system and there's a lot more stakeholders. But I do think it's important that as an industry, as a community, we continue to press on that because, to your point, I mean, the innovation is here, the capital is here, the end user patient market is here. Yeah. European physicians are, in many ways, much more open to innovation and adopting new therapies. I mean, if you look in interventional cardiology, where I started in medtech, there was like a 7-8 year lag, maybe longer, between the adoption of transradial, so through the wrist, PCI access, which has a much lower complication and infection rate than transfemoral. And that was because they were like, this is better, let's do it. But yet the regulatory framework is a real obstacle, and I think we got to sort of figure out how we can improve that. But
we need to push all of us.
Yeah. So just to maybe close on a note about traditional VC, I mean, that's what has to sort of support companies scale up and eventually keep prolonging the holding time, waiting for the exit. How active are you guys, and what do you like to see in this time, in this context? What are your preference? Maybe Clara
You mean in terms of
in terms
our
of
VC?
what do you like to invest in given
Yeah.
the current situation?
I think when and I'm just speaking generally, not only medtech. I think that when we started in summer 2018, so 5 years ago, we started as a fund trying to invest across the board, really across the board. Not saying we do medtech and do just one company. So really doing medtech and really doing health tech in general, plus biotech, biopharma. Our hypothesis then was that the market will consolidate substantially. And thanks God, it has happened really, right? So we do see not only pharma companies acquiring or being interested in digital, but we also see a lot of medtech, which is not hardware only, which has a lot of data, so these conversions. But even drug discovery is being involved now with a huge amount of computational data. So having a team that is able to understand this complexity, or not only the team, because we don't know about everything, as none of us do, but just trying to make sure that we understand and we are able to take advantage of all those convergency of the market and the industry, put us in a very nice position and created a lot of synergies regarding talent, regarding how we try to advise our companies on the regulatory path, for example, coming from the biotech, understanding, when you come from pharma, all these new regulation may say, okay, of course, that's what we have to do, right? So even in the digital field, which was not as typical to see this regulation some years ago. So I think that We like to see companies that are not only in one or the other. Science needs to make sense. It needs to be disruptive enough to make sense economically when the products reach a market. I think that having the product in the market in mind is a must. And we like investing in companies that really are able to play a little bit with all these technologies and understanding them. I think that we do see a nice fit with us in those ones.
Thank you. And Enric, I mean, yours is much more of an institutional role, but maybe you can tell us what the EIC is in general more interested in, definitely filling a gap that there is into early stage companies, equity and through equity and grants, but any subsector in particular or any technology in particular?
Yes, so we have like two different strategies. One is the open calls, and for those you can submit any topic, and this is pretty open. And then we do have some areas that we identify as with highest potential. And these are challenges that we launch from time to time. And one of those areas is cell reprogramming and tissue engineering. We've been looking at this for quite a long time. We think there is an opportunity there. Maybe the time frame is well suited for us because we might wait a bit more. It will take longer to get those hybrid medtech, biotech, tissue engineering into the market, but we're looking into that a lot. Some of the things that are closer to traditional medtech. I saw this acquisition, Bigfoot, I think, this past few days. And it's a very interesting approach I've seen before, where you have these add-ons to maybe legacy systems, and you turn them into telehealth compatible. And this is a very smart approach. It's economically very viable. It's shorter term. So we're looking at these two sort of time frames: a long time frame where cell programming, tissue engineering, grafting whole organs. It's one thing we're looking at funding, but also the shorter term. This, for example, add-ons to legacy devices to turn them into sort of more modern digital-based things.
Thank you. And Alex, are you more into still traditional medtech, or are you opening up to data?
So yeah, we've evolved our strategy as some of these new technologies have emerged, and we remain focused on growth stage investing. That's consistent, but we've explicitly added digital health to our fund mandate. We've hired a senior investment director out on the West Coast who is focused exclusively on digital health in the US. I work with him and the rest of the team here in Europe on sort of transatlantic and European digital health opportunities. So I'd say our current portfolio and our deployment strategy going forward is roughly a third traditional medtech, a third digital health as a baseline, and then the balance will be just the best deals that we find.
Opportunistic.
Yeah, opportunistic. So it could end up being 70-30 medtech, digital health. I probably won't skew the other way, but I think medtech will remain roughly half the portfolio over time, just given the tremendous opportunity in medtech.
And when it's digital, it's pure digital, or it's a combination when there's...
Both. I mean, we've done pure digital kind of software selling into insurance companies and small businesses in the US for managing insurance benefits. So really a software as a service, kind of almost a business optimization play. So really far away from interventional cardiology products. And then we've looked at, what I would consider more our sweet spot of kind of tech-enabled medical device, advanced imaging, connected devices for monitoring or managing, chronic diseases, and then sort of image-guided therapy, whether it's standalone or sort of integrated into the therapy, as is the case with something like Sonata, where you've got a traditional RF ablation catheter, but it's merged with a ultrasound guidance system and an imaging console to help guide the therapy, during the procedure. So it covers the full range, but we think, digital is real and it's very much part of our strategy.
And the situation for the pure digital is similar into IPO-wise, or?
No, I think to Clara's point, I think for, pure digital, I think there's a lot more opportunity to exit to private equity, because those are businesses that have much lower capital needs and can generate nice high margin recurring revenue and cash flow. And I think the private equity buyers, they want cash flow. That's what they buy, that's what they pay for. And they don't have a commercial infrastructure that, like a strategic does, that they can drop it into and then leverage. So I think we expect to see more private equity exits for the pure digital than for traditional medtech.
Okay, well, I think we're done. Can I close it here? And thank you so much for coming here and sharing your thought. And
Thank
thank
you.
you for attending.
Thank you. And thank you for